We'll go ahead and get started. And again, thank you for joining us in the aftermath. We're going to dig into yesterday's USDA report. It was one of the bigger reports of the year in that USDA, in its May report, releases its new set of supply-demand numbers, new set of balance sheet numbers for the new marketing year. So the crop that's just getting planted right now. This is USDA's first look at where they think supply is going to be, where they think demand is going to be. Of course, those are guesses to a big extent at this point in time, but it is the kind of lays the foundation for the rest of the year and the numbers that they'll potentially change down the road. So with that. Dig into the report numbers, and we'll kind of go through a summary of those first, and then we'll go through the crops and talk about each one in a little more detail. But as far as the numbers yesterday, we, for the most part, didn't get too many surprises. The corn, actually, if there was a surprise, it was a little bit bullish on the front end that USDA did not have a big increase in old crop stocks. They left stocks just about 2.1 billion bushels. And that was a little bit of a surprise. Most of us thought that USDA would raise its old crop stock number due to decrease in ethanol production and ethanol usage of corn, but that did not happen. So that was a little bit friendly to the front end months. We didn't see or we actually saw the July contract bump up a little bit yesterday at the close, while the deferred contracts were a little bit weaker. Soybeans, USDA did raise old crop stocks 580 million bushels, mostly due to the lack of exports, I guess. That was where they had made the cut. Wheat stocks were left about unchanged. New crop numbers, which is what we were really all waiting to see. USDA came in at 3.3 billion bushels of corn, which was about as expected. Still a big number, but that was kind of what the trade was expecting to see. For soybeans, actually a little bit of surprise that we actually had a little bit lighter number at 405 million bushels. Of course, that is subject to change. And wheat stocks were a little higher than expected at 909 million bushels. South American production, USDA didn't make any significant changes, still showing big crops in both Brazil and Argentina this year. The world numbers, when you look at some of these overall numbers, I grabbed this headline from USDA's report that record corn, record wheat, record rice stocks, or not record, but all three of those crops expected to build here in this year ahead. So that's a bit discouraging when it comes to the markets and what we're expecting from price. When you look at world stocks, you know, some of these numbers are pretty big, especially out into next year. Corn stocks at 339 million metric tons. That's up 20 million tons. That's not quite 10%, about 7% increase, but still a big number. Bean stocks expected to maybe ease back a little bit with good Chinese demand. Wheat stocks expected to grow almost 20 million metric tons at the world level. And we'll talk about reasons why here in a little bit. Crop progress, kind of flipping back there. We're seeing a good start to the crop year in most crops, especially in the western parts of the Corn Belt, but 67% of the U.S. corn is planted as of Sunday night. Iowa is 91% planted. I'm not sure if that's a record pace for Iowa or not, but it's pretty close if it's not. Nebraska is up to 79, Minnesota at 89. So we're seeing some big progress made in those Western Corn Belt states. Illinois at 68 didn't make as much progress last week, but certainly has been ahead of normal as well. So the heart of the Corn Belt doing pretty well as far as getting a good start. Soybean planting is at 38%. That is better than average by 15 points. So again, that's a good number. And by the way, I'm not sure how to, but if you could all mute your lines, I would appreciate it, and because I'm getting a little bit of feedback. Winter wheat is on pace, just about on average pace as far as the percent of the crop heading at 44%. The rating did drop a little bit last week, a couple points, which was initially a little bit supportive to the market. Spring wheat planting running behind normal by about 20 points, most of that because of North Dakota. And we'll talk about maybe a little bit of that after a bit, but certainly off to a little later start north of really northern South Dakota up. Cotton planting has caught back up. It was a little bit behind early on, but now we're a little bit ahead of normal. I think most of Texas is doing well. The Delta remains fairly wet. Georgia and the Southeast has dried out a little bit over the last week or so. And then sorghum planting is catching back up to normal pace. So all in all, really not much to talk about there. Now, weather-wise, here's a snapshot of the last 14 days precipitation, so you can kind of see where the areas are that have probably made pretty good planting progress. And I mentioned the western corn belt, but Iowa, Minnesota, eastern Nebraska, northern Missouri, this area right up through here has had very little precipitation, so it's made some really good progress. The southeast has finally started to dry out just a little bit, and so hopefully getting some work done there. And of course, out in the southern plains where it's been fairly dry, they've been able to get some work done as well. Now, this area up through Louisiana, Arkansas, Missouri, Illinois, been pretty wet over the last couple of weeks and has seen very little very little field work, as well as we've seen some of these areas up into eastern North Dakota, northern South Dakota as well. As far as progress compared to normal or compared to some previous years, you can see the corn numbers running at one of our better years that we've had over the last 15 or so years. So it's doing quite well. By state, again, going back to some things we talked about a minute ago, Iowa at 91%, that's 25 points ahead of normal. Minnesota's 32 points ahead of normal. But you can also see some of those wetter states like Missouri, Tennessee, North Dakota running a little bit behind as far as getting the crop in the ground. But overall, still some pretty good progress at this point. Soybeans, so far it looks like the fastest year we've had of soybean planting in the last 11 or 12 years. And when you look at it by state, again, these Delta states especially have been running a little bit behind, as is North Dakota, but we've seen a lot of areas, including Iowa, 47 points ahead of normal getting the bean crop in the ground. So it's hard to generate much bullishness in the market when we're looking at big stocks and we're getting the crop planted in a very timely manner. Spring wheat planting is running behind the 5-year average, and again, most of that because of the North Dakota wetness that we've seen and having some issues getting that crop in the ground. Now, the next few days, we've got some haves and have-nots. It looks like this Gulf pattern is going to be bringing some moisture up through eastern Texas all the way up into Michigan, Ohio. So this area, some of this area that's been getting water is going to continue to stay wet and probably see very little progress over the next week or so. The southeast expected to continue to clear up, so we would hope that area is going to make some pretty good progress, as well as maybe North Dakota and some of the areas that have been struggling a little bit. So overall, we do have some areas going to get fairly wet, but we should have some other areas that make up good progress here in the next week or so. The extended forecast maps, warm and dry through much of the country in the 6 to 10 day map. We do see maybe a return to some precipitation up north. The 8 to 14 day map, very similar, above normal temps for much of the country, below normal precip on the eastern seaboard, extending back into the middle of the country. And then the latest long-term forecast out into May, June, July generally is for warm or normal temperatures for most of the country and ample rainfall for most of the country. So it's, again, hard to get bullish at this point in time with the forecast not calling for a drought by any means for most of the country. And yeah, you could say maybe warm temps, but at this point, it's just there's nothing there really to get excited about. We'll see if that changes, but at this point, really nothing bullish to get behind. So kind of looking at commodities in general, I thought this was a good place to start. I saw this chart this week that the number of people eating at home. Of course, that's gone up a lot. So. And you can see the food at home prices surging. I don't know if that means that grocery stores are raising prices or if we're buying different products at the store or what, but I just thought this was pretty fascinating that we've seen a surge in home prices. Maybe it's because we're buying groceries online. I don't know. I'm not, but maybe some people are. Maybe that's what's causing prices, this number to go up. The Thomson Reuters, the commodity CRB index, which is a basket of commodities, it has rebounded a little bit over the last month from the lows that we were making back in late April, probably about the time we had this meeting last month. We have bounced back up. Most of that is because of the crude oil market. Oil has come back off of its bottom. Still really cheap, relatively speaking, at $25 a barrel, but that's lifted commodities in general. But looking at our markets in the last 30 days, find this exercise kind of interesting to go back and look at what we've done, and it's not been a very good month for most crops, most markets, with the exception being cotton. But a month ago, it was kind of interesting that this same picture showed that in the previous month, corn and cotton were the markets that had gone down, all the other markets had risen. So soybeans and wheat have basically given up in the last 30 days what they'd made the 30 days before. Rice, kind of similar situation. It's gone down what it had gained. Cotton has gained what it had lost. But corn is the one exception, that corn lost a month ago and has lost again in the last month. So, and the fundamentals continue to be negative, and we'll look at that here in just a moment. So flipping to corn, here is the updated balance sheet from yesterday. The May 1920 numbers, one with the colored numbers, these are the old crop numbers. So this is the marketing year that we're still in.
97 million acres of corn this year.
So that's the year that we're still in. USDA did make a few changes. They did lower the harvested acreage number, and that comes from the resurvey that they did in 4 of the states up north, in Minnesota, Wisconsin, Michigan, and South Dakota. They have not resurveyed in North Dakota yet. So there's a pretty good chance that these numbers could come down a little bit in maybe a subsequent report. But USDA did drop harvested acres 100,000 yesterday. They took the national yield down 0.2 of a bushel, which did lower production slightly in yesterday's report. Now, they also made some changes in the demand numbers. They increased feed demand. They increased export demand, which was a little bit surprising. But they also reduced ethanol demand, as we all expected to see. And at the end of the day, ending stocks virtually were unchanged. I think they went up like 6 million bushels or something. So when all the numbers were settled out, we saw very little change here. Now, that was a bit of a bullish number by itself, because I think most of us expected 2.2, 2.3 billion, something like that. So
1 billion bushels. Estimated for next year's almost 3.4 billion bushels.
hey folks, I'm not sure who's unmuted, and I don't know how to do it, but if you could mute your phones, I would appreciate it. Thank you. Looking ahead, this is what most of us have been waiting for, was to look at the new numbers, and USDA stayed with its planting intentions number of 97 million acres. They stayed with their baseline yield projection of 178.5, which would give us a total production this year of a record 16 billion bushels, or just shy of 16 billion bushels. On the demand side of the equation, they did increase demand in just about every sector. They increased feed demand to a record over 6 billion bushels. They increased ethanol back up to 5.2 billion bushels. Still not back to where we had been previously, but nonetheless expecting some of these plants to start cranking back up. And they increased export demand to over 2.1 billion bushels. So at the end of the day, they say we're going to use a record amount of corn next year at 14.8 billion bushels of corn. And even with that record usage, because of the increase in production, we would see stocks going up to almost 3.4 billion bushels of corn. Now, this was kind of an expected number from the trade. I don't think we expected anything different from this report, but it's a bit sobering, I think, as we come into this marketing year, that we're putting a crop in the ground and we're potentially going to raise 15 to 16 billion bushels of corn. And if we do that, and even if we use the heck out of this stuff this year, we're going to see stocks over 3 billion bushels. So it's a bit disheartening, I think, certainly. Now, it is early in the marketing year. In fact, the marketing year itself hasn't even started. It doesn't start until September 1st, but we still have crop weather ahead of us. There's a lot of things that can happen, but this is our baseline for where we're going to start at. USDA estimates average farm price at $3.20. That's pretty ugly as well. And we'll talk about the impact of that potentially later in PLC and ARC payments. But that, as you can imagine, kind of puts us down into some fairly large payments potentially if we see that kind of a number. The stocks to use ratio, just kind of toggling back at 22, almost 23%. Here's what that looks like historically. That would be the largest it's been since, I believe, 92 or 91, something like that. One of the positives of late, I guess, but this is certainly going to be a big subject for corn demand, is going to be ethanol. And we did see ethanol production increase over the past week. So we need that to continue to increase. And really, for that to happen, we're going to need this oil market to continue higher. And at $25 a barrel, it's probably not going to cut it a whole lot. So we really need to see that pick back up. And I think people are somewhat optimistic that that'll happen as we start to reopen our economy. At the world level, USDA did put out, I showed you the headline a little while ago, but record world corn production expected this year. Of course, the United States, the big part of that, but we're expected to see production exceed consumption at the world level, and that's how we're going to not only grow U.S. stocks, but world stocks as well in the year ahead. So from a chart perspective, here's kind of where we are historically, and I had to widen all the way out to the monthly chart in corn just to kind of give a perspective. But over the last, a month or so ago, we did go down and test the 5-year low at 301 on the front month, and that was in the May futures contract. We have bounced back off of that now that July is the lead month. But, that's a little bit tenuous, I think, at this point in time, if we're still staring at these big stocks numbers in the year ahead. So this 301 level is going to continue to be, I think, a bit of a magnet for the front end contract, whether it's May, July, September, December corn. So kind of keep that in mind when you're thinking about carrying corn. If it's unsold corn, and until we get some kind of a crop issue somewhere in the world, until we have trouble and start to deplete stocks, this could continue to be a magnet for this market as we go forward. Looking ahead, I not only looking at USDA's number, but I looked at some alternative numbers because I don't think everybody believes fully that we'll hit USDA's projections. So I kind of did a couple of other ones and said, okay, I think these are maybe more realistic. So alternative A is, what if we only planted 96 million acres of corn? And what if the national yield was only 177? So you shave both of those down a little bit. That would cut us about 300 million bushels out of production. I think beginning stocks are likely to come up. I don't think that the export number and the ethanol number are going to quite get to USDA's number. I'm projecting 2250 as beginning stock number. I also think that that ethanol demand this coming year, it's going to be tough to reach the 5.2 billion given the start that we're likely to be in, but we'll see. Export demand, I also shave that back a little bit to 2 billion bushels. Again, seeing a growth of 375 one year to the next would just be huge, and I hope I'm wrong. But if we only export 2 billion bushels of corn, we're basically looking at stocks about where USDA had us at. Another alternative is, what if we shave another million acres off, go to 95 million? Maybe I don't take my yield down as much, 177 and a half. Going through the numbers again, we're still over 2 billion bushels of corn, or 3 billion bushels of corn. So some things are going to have to change really to make this market very positive. And that's where the stocks matrix comes into play. I like this type of a look to be able to kind of say, okay, what has to happen with bushels or with acres in order to get us in a friendlier market situation? And I think at this point, just getting below 3 billion bushels would be something that would get us to at least, okay, maybe this market doesn't need to go down anymore. Maybe there's some potential to go higher. So the way the stocks matrix works, I used USDA's numbers up here, and USDA says we're going to start this marketing year with 2.098 billion bushels. They say that we're going to use 14.8 billion bushels of corn. So we'll assume that those happen. Then we've got different acres across the top, and I've got acres on the left and yields across the top. Then the numbers inside the boxes here are all representative of ending stocks. So we're going to take the beginning number, multiply by production. subtract demand to come up with these numbers in the boxes. The dark green numbers are all above 3 billion bushels. The bright green numbers are between 2 and 3 billion bushels. Then you get down into the gray numbers below 2, and then the red numbers start to become more of a rationing type situation. This acreage number at the very bottom, that was last year at 89.7. USDA says we're going to be at 97 million acres. That's up here near the top. And so you can kind of see at 97 million acres, if we have 178.5 bushel corn, like USDA says, we would have a carryout of 3.31 billion bushels. In order to get below 3 billion, you'd have to take yield down to around 174, 175, which is possible, but kind of just shows you here on the chart where that would, where that yield would have to go to become somewhat friendly. If we plant 96 million acres, you can kind of look at the same numbers. If you had a yield like 2018 at 176.4, now you're down below 3 billion bushels. The other part of this that I don't show here is, what if I don't get to 14.8 billion in demand? What if we're only 14.5? Then every number on this chart goes up 300 million bushels. So again, we're coming into this year. It's just difficult in corn to make a positive look on this balance sheet unless we just have a severe problem with production, and we'll see if that happens. But that being the case, I know that based on this, I need to be doing something to defend myself in the market, and so we'll talk about that here as we move ahead. And by the way, I will continue to update this matrix in the daily market report. I'll update it each month when we do this webinar as well, as we get more and more information about planted acres, as we start getting yield defined a little bit better, we'll be able to continue to go through this. Now, the funds, as we entered into the report, I mentioned in our market report this week that the funds are short 190,000 contracts of corn. And so they're bearish as well right now. They're betting that there's no reason for corn to go up. They're betting that eventually the farmer's going to have to sell, and that's going to continue to keep pressure on the market. But historically, you can see what's happened over the last 5 years. From now up until July, this is the time of the year where the funds typically end up buying corn. And usually we get a weather scare. Something drives this market and drives these people back in as buyers. And today, I don't know what that's going to be, but that's usually what causes them to become buyers. And it happened last year. The red line is a year ago, the funds net position in the corn market. These managed funds were record short, over 300,000 contracts of corn in late April last year. Became big buyers of corn when we had trouble getting the crop in the ground. And then we had some weather concerns as we got into the early part of the summer. So it seems like each year there's a point where the funds buy, and then maybe we solve the weather issue, whatever happens, and then the funds turn sellers again. So if you're an optimist, and most of us are, and if you're holding old crop corn or waiting to sell new crop, we're really, really counting on some sort of a fund-driven rally. They've got the ammunition to do it. They're short corn right now. So if something happens, I don't know what it's going to be, but if something gives them the reason to step back in and buy that short position back, to me, that's if that happens, that's our opportunity to unload all your old crop corn and be an aggressive seller, marketer, option trader, whatever, to get something locked in on the new crop and be looking ahead, maybe even into next year as well. And I'll talk about that here in a minute. So historically, what happens, and I shared this chart from more research in a couple of my market reports in the last couple of weeks. But again, it kind of shows us what we typically see is that the market, and this is what they did, is relate this year's trade so far to 6 years that had a very, very close correlation in price movement. And you can see those over here on the right-hand side of the page. And in each of those 6 years, or the average of those 6 years, saw a bounce in corn futures from now until about the late part of June, before the market eroded and went down and made new lows at the end of the year. So again, we're all waiting for this to happen. We're hoping it happens. Hope is not necessarily a good way to live or lives by, I guess, from a marketing standpoint, but we'll see if it does happen. But historically, we get a bounce. Historically, then this market continues lower. So here's where we're at today in December corn. We've gone down, maybe made this short-term bottom here in late April. We'll see if that can hold. I did update this chart right before the meeting started, so it does show that the market had dipped a little bit here this morning. We're back down to 333 and a quarter, and you can kind of see that the blue and the red lines, this 9-day moving average is the red and the 20-day is the blue. Those have really held us in check since back here in January when the market started to drop. And the last few days, we've tried to push through that 20-day moving average. We failed again here this morning, and we're dipping back down a little bit. I've got a lot of green lines on this chart. These are all of our crop insurance numbers, and I find this very helpful to know right now how my crop insurance policy is acting. What is it doing for me from a marketing side of things? Because most of us don't want to go out and forward sell any new crop corn today. We know that. And so if you bought an RP policy this year, and you're in most states, that revenue protection policy price, base price, was set at $3.88 back here in February, or an ARP policy. Then these other light green lines show that assuming we have an average yield, so either if your county or your individual yield is exactly at your APH, then we know that because of the price drop that these policies would start to trigger some revenue indemnities. And so the 90% ARP policy only has to have a 10% drop in price. That's at $349. The SCO, many of you may have bought the additional SCO coverage up on top of your revenue policy. That's at 86%. 86% of 388 is at 334. We're just below that level right now. So we've had prices basically drop about 14% from where the base price was set back in February. If you have an 85% RP policy, assuming you raised a yield this year exactly at your APH, then a price drop below 330 in December corn would start to trigger an indemnity payment. 80% is down at 310. So you can see the value of the higher level coverages right now really comes into play in a year where the price drops like this. I also need to mention margin protection. I was just on the phone this morning with somebody who had a margin protection policy. Margin protection insurance has two things going for it. Number one, it set its base price back in September last year. That was up at 403. The other thing the margin protection has is a 95% policy. And so if someone bought the 95% policy, which most people that use that protection do, 95% of 403 is at 383. So right now, assuming that your county had an average yield, and assuming that the input costs didn't move, which most did not, 383 would be the price trigger, and that's 50 cents above where the market's currently at. So anybody with a margin protection policy at 95%, or a 90% ARP policy, or an SCO at 86%, all of those coverages right now, I would call those in the money. They're providing some market protection for us here for the 2020 year, depending upon, of course, what the yields end up being on your farm and or for the county. But at least we know we have some protection. And if we do see D's corn go down and test that 301 number that the spot contracts have been at, then most of these policies are going to be providing us some price support. So it probably gives us reason not to have to panic today and jump into the market and do something. Now, a quick glance down at the bottom, the RSI is at 39 right now. Probably not a place that I need to be doing anything marketing-wise. The stochastics have been climbing as the market has risen a little bit lately, but again, not anywhere close to being in an overbought type scenario at this point in time. D's 21, and we'll go back to this in a minute, but the one thing I wanted to point out here is that for those of you that plan on farming for more than 1 year, which I think most of us that farm are, D's 21 corn is trading 30 cents higher than the D's 20. We're at 365 right now. D's 20 is at 333. So there's a big carry being built into this market. There's a huge incentive built in right now for storage. 30 cents for a year, and that's a pretty good amount of money. That's 2.5 cents a month. That could widen out a little bit at some point in time, but it just shows you what the incentive is right now. Now, I'm not a big proponent of selling corn at 365, but I think I would get more interested at 380, 385, 390. And so I want to be looking at this 100-day moving average line, this purple line at 389.5. I'm not so sure I wouldn't be looking at hedging some corn out there. And maybe it's even your 20 crop that you would plan on putting in the bin and storing out into the 21 year. But I think that 389.5, the 401 is the 200-day moving average. To me, those are some targets to consider because of this large carry that the corn market is offering. That's not a bad place, not a bad way to be looking at selling some corn, whether it's this year's crop or next year's crop or whatever it is. If you've got some space, it's the highest price on the board right now, and so it's not a bad idea maybe to consider doing that. And we'll talk about that a little bit later on as well when we talk about insurance. Flipping over to soybeans, the balance sheet for beans, USDA did give us a bearish surprise yesterday. They did lower crush, which we've been on an amazing crush pace, so I'm not sure why they did that, but they took 10 million bushels out of the crush. But they also took a big chunk out of the export number, dropped us about 100 million bushels here, raised ending stocks 100 million bushels to 580 million. That said, even with a 7+ million acre increase this coming year, and even with a decent yield, USDA was very aggressive with its demand estimates, in particular the export number. They raised exports 375 million. I think they're really counting on China coming in. And if that happens, stocks would actually drop back to 405 million bushels, which is pretty amazing to me that we could raise 7 million more acres of beans this year and still see a drop in ending stocks. So we'll see what happens, but I'm still not 100% of a believer that we'll get to 2 billion bushel export demand in the year ahead, but that's the numbers that they put out yesterday. And also USDA on average farm price, they lowered the old crop price to $8.50. That comes into play for ARC, especially for this year. Anybody that signed up for the ARC program, we'll talk about that after a while. And for new crop at $8.20. And this comes into play with PLC for next year as well, in addition to ARC. So again, we'll talk about that with the government programs. The reason, and it made sense that they dropped the export number for the old crop, because here's where we're currently shipping on a weekly basis. Last week we were down around 496 million bushels shipped. In order to reach USDA's previous estimate, we would have to get to over 750 million bushels a week. That's not likely to happen from now on through the rest of the summer, given that Brazil is just cranking out bean boats right now that they've finished their harvest. So USDA really needed to drop that export number. It was too high, and they did that in yesterday's report. Stocks to usage, though, when you look ahead at their projection for next year, it shows us dipping back down again. And so there's reasons for a little bit of optimism here in beans. If you're a believer that China is going to fulfill its phase 1 trade deal obligations, then there's reasons to maybe be a little bit supportive to the bean market going ahead. Now, the good news is China's been starting to crank up imports, as they typically do this time of the year. Now, part of the reason they do it this time of the year is because this is when you see new crop beans out of Brazil. They also tend to do it in the fall when the U.S. harvest hits. So historically, that's been the case. Now, looking at where they're buying those beans from, here's monthly Brazilian soybean exports, just off the chart here so far in the month of March and on into April. And you can see Brazilian soybean exports to China also at the highest they've been in the last 7 years. And so China has kind of dwindled down its inventories. Certainly Chinese imports were way down throughout the winter months and on into the early spring due to the COVID outbreak. Things had pretty well shut down, and now they're trying to replenish their domestic supplies. And so not only are they buying beans out of Brazil, certainly they have bought a few beans out of the U.S. as well. And we did see a sale announced this morning of 6 vessels going to China here for old crop. But here's a snapshot of Brazilian beans on the water right now. I've showed this winter, and I think a couple of months ago, I showed a snapshot, and it was pretty light. But you can see that apparently China's opening back up because there's a lot of boats heading from Brazil over to that part of the world right now. So they're needing to replenish their inventories, and it looks like they're getting it done right now. And another reason they're buying out of Brazil is the currency valuations. You look at the Brazilian real, still continues to make a new low against the U.S. dollar, and that's making Brazilian beans awfully cheap. So the U.S. market, this is a weekly chart. This goes back to 2018. You can see that we've generally been in a downtrend since the beginning of the year. Most of that due to the Chinese lack of buying. Most of it, that due to COVID, and you can put some other blame there. But we have seen a bounce lately. We've pushed back up to near 850. I've been hopeful that we could push back up to the $9 mark or 850, at least in new crop beans, 850 to $9. You can see we've got a cluster of moving averages up here around 880 to 885, and that might be the limit here on the old crop market if we're able to get much of a bounce. But if China continues to buy some old beans, I would tend to think that we might see a little bit of a seasonal bounce in the old crop bean market. Now, looking ahead at some alternative supply-demand numbers, I would tend to think personally that these are more realistic, that acres are probably going to be up a little bit on soybeans. I would tend to think some of the North Dakota acres, for example, probably won't go to corn. We might see a few more bean acres up there in addition to some prevented plant. And just in general, around some areas of the Corn Belt, I would tend to think there's probably a little bit of switching. I'm not in the camp of some people thinking it's going to be a huge number away from corn, but 84.5 million wouldn't be a shock if we see an extra million acres of beans. And assuming maybe a slightly better yield than USDA is, 4.1 to 4.2 billion production's probably likely. I'm a little friendlier on the crush because of the hog numbers. I'm a little bit more negative on exports. I would tend to think that that's a huge task to try to get 375 million more beans sold this coming year. And at the bottom line is I would tend to think stocks might be upwards of 500 million bushels in the next year. Again, all of this is just numbers on a piece of paper right now, but I would tend to think that the odds are that we're going to be above 405 in the year ahead. So maybe not see a big drop back from this current year like USDA was projecting. Price-wise, I would still think they're probably in the ballpark, probably in the low eights, given some different alternatives for next year. So when we look at the matrix, again, kind of like corn, we start with 580 million bushels. USDA says right now we're going to use 4.315 billion this year, and at 49.8 yield, and USDA's acreage at 83.5 gives us carry out at 430 million bushels. And you can kind of see then what has to happen in order to get maybe more bullish, more bearish. Certainly if we get up into these green numbers at 600 million plus, you start to get a little bearish, I think. So at 85 million acres, if we had a 51 plus yield, to me that becomes pretty bearish. If you keep acres where they're at right here, but fall back a half a bushel and use all of these beans, that tends to be a little bit bullish, I think, to beans. So beans, unlike corn, don't have to move a whole lot one way or the other in order to get somewhat of a reaction from market. And so I just wanted to show that. We'll continue to update this chart as we go forward. Coming into the report, funds, they're basically even the bean market. And I think, given what I just showed in some of these numbers, you can make an argument one way or the other that beans can go higher, beans can go lower. And I think that's why the funds have chosen to sit on the sideline right now, that there's just not too much information telling us that we need to be one way or the other. But historically, I think this is interesting. The funds have had a couple of years where they've had some huge long positions. In the 15, the 16, and the 17 year, going into spring, they were big time long the bean market. The last couple of, in 14 and then last year, they were short beans this time of year. And so it's not a clear-cut scenario what the funds do with the soybean market because of Brazil, certainly one of the big factors, and then of course because of China. So going forward, yes, they could basically trade either direction. Historically, the Moore Research group only found 2 years where we saw price really identical to what we've had so far the last 4 or 5 months of this marketing year. And so historically what they mapped out, what tends to happen is we would trade beans somewhat sideways as we get into early summer and then tend to trend a little higher as we get into the late part of summer. So we'll see. That's not a big sample size. I get that. But I thought it was interesting to see that maybe there's a chance that beans, assuming China buys beans, that maybe there's a chance that this bean market could have some potential upside in front of it. So the November chart, here it is. Again, we've got our base prices up here, margin protection at 932, the RP base price at 917. The margin protection 5% drop is 885. So beans are in the money right now for those that had a margin protection coverage. For ARP at 90% on down, we're not down to that level yet. So your beans do provide some downside protection, but we would have to go down quite a bit further to get in the money there. So we hope that doesn't happen. We're hopeful for a rebound. This 100-day moving average, the purple line at 902, I think would be a heck of a target for me, and I would probably fade that by at least a nickel. So if we get beans to 895, I think that would be a tremendous opportunity to be doing some more selling for those that need to catch up. Right now, the RSI, pretty middle of the road at 46. Stochastics, they've all turned, though, here the last couple of days. So we'll see if we can flatten this thing out. But that's not a good sign. But if we're able to trade higher at some point, I think this $8.90 to $9 area certainly would be an area I would want to target with some sales. Looking ahead a year down the road, it's kind of interesting where corn, there's a huge carry from one year to the next. We got 30 cents from one year to the next. You look at beans, we're 851 right now and 841 out into next year. So beans are actually in an inverse. So there's no reason I want to be a marketer of 21 beans, but I just thought I would show you that. And if nothing else, it makes it a little more important to be selling our beans on the front end, taking advantage of what's an inverse in the bean market looking forward. Wheat, the wheat balance sheet, USDA did make one little change in the old crop. They did reduce exports, I think 8 million bushels, raised ending stocks 8 million to 978. This is the first year in 4 years that we'll have stocks below 1 billion bushels of wheat. So on the surface, that's a little bit friendly to the wheat market. The other thing that's friendly to wheat is planted acres, and we've been talking about this for a while, but winter wheat seedings were way down. Total planted acres, USDA estimates a 500,000 acre drop. I believe that's the lowest wheat number since 1909. Somebody might be able to correct me on that, but I believe in over 100 years, this is the least amount of wheat that we've planted and will plant this year. And subsequently, production would be expected to drop, maybe 60 million bushels. USDA expects demand to ease back down, feed demand, probably with cheap corn. We're not going to feed as much wheat. Export demand's probably going to dip a little with the return of Australia, Europe, some other better crops. But even with that, we would expect ending stocks to drop down around 900 million bushels. I would have projected a higher average farm price, maybe up closer to $5. But USDA, I think, also sees that with cheap corn, that wheat probably won't separate itself that much. And so they're forecasting right now an average farm price the same next year as what we had from this year. U.S. numbers by class, when you look at those, the soft red wheat was probably the most negative above the trade guess, probably close to 20 million bushels above, 18 million above the average trade guess. All the other ones were close. All winter wheat 10 million above, actually hard wheat 6 million below. So, but overall, you can see the breakout by class. At the world level, USDA projecting world production will outpace consumption this year, kind of like corn, this second straight year. And so that continues to linger over the top of us. When you look at which countries are expected to make the jumps, the one that really stands out is Australia. Australia's had 2 straight drought years, had a lot of fires this past year. They're expected to return back to normal. If that's the case, that would be about a 58% increase in production. You can see other countries. Argentina is expected to be a little better. Their acres are going to be up this year. Russia's expected to improve a little bit. The EU is expected to be down. They're seeing some drought in parts of France right now. And, of course, U.S. acres and production expected to dip a little bit. But overall, looking at some big, big numbers in wheat in the year ahead. And so that's going to continue to linger. And when you look at some of the breakdowns by class, the spring wheat market had a little bounce over the last week or so, really wasn't able to get back to a level that we would have gotten excited about doing some selling. I've been kind of eyeing this 100-day moving average at 551 as a level. And if you go back a month or so, that was right where the highs from late March were at. So I think in this meeting in April, we said, hey, if we get back close to that 100-day moving average, it'd be a great selling opportunity. We continue to go down and make a new low. We've bounced a little bit, but you can see the RSI just barely got to 50 here a couple of days ago. And now we're trying to hold support at the at the 9 and the 20-day moving averages here down in the lower 520s. But again, I think a return back up around this 5.5 level, 545 to 550, I would probably be a fairly aggressive seller of some September wheat. Now, the one thing the wheat market has going for it, especially spring wheat, is the funds are right now holding, I believe, a record short position. It's not a huge amount of contracts. It's 24,000 contracts, but they've been record short the spring wheat market for a number of months now. And so if there's one potential, it's that maybe spring wheat acres don't all get planted, or maybe, some sort of a crop scare. Maybe you see some fund buying take place in this market. So that's what we're going to watch in the weeks ahead. If the funds get back into this market, that's what I want to look at as an opportunity to be hedging some spring wheat. Looking at Chicago wheat, we're still holding 20 cents above the revenue insurance price. We're at 505 here this morning, really holding this support, the low that we had earlier in the month. In fact, we did dip below it just a little bit here early this morning. So we'll see if that can hold. Otherwise, you've got your March low down around 494 as support. The RSI is in the low 30s. So again, not a level that I'd want to be a hedger at this point in time. The one thing I would point out on this chart, though, and I do talk a lot about the RSI, the Relative Strength Index, and the stochastics lines. And you can look at the number of times that the RSI on July wheat has hit 70, this red line, which was usually an overbought sign or a sell signal. We've had a number of those this year in Chicago July wheat. So we're far from it today. But again, hindsight's always pretty good, but these were great times to be doing some hedging in this July wheat contract. And the funds in Chicago wheat were basically at zero going into this USDA report. So kind of like, soybeans, they were basically wait and see on this market. But you can also see that over the last 8 years, they've spent the majority of their time on the short side of the wheat market. There just hasn't been a whole lot of supply issues around the world, and consequently, they've been short the wheat market. I would be a little nervous if we do hit USDA's projection on world wheat this year. I would tend to think that these funds could go back to the short side of this market. So going back to the chart real quick, a return back up here around the blue line, the 200-day moving average at 528, this light blue line, maybe 520 to 5.25. At this point in time, I think that'd be a good hedge going into summer. You could put some targets in up at the 50 and the 100-day moving average, but I think in around this 5.25, 520 level be a good place to get some wheat hedged, given the world numbers that we're looking at right now. Kansas City wheat, very similar chart, just different price levels, but you got the RSI and the stochastics very oversold for both at this point in time. You can see the number of times we've had at least 3 times that the RSI has hit 70 this year in Kansas City wheat. So all of those would have been good sales opportunities. As of today, we've kind of broken this market into new lows. I think a target right now looks to be up around this 470 area, which is where we've got a cluster of moving averages. I think you get back up into that area, I would be a fairly aggressive seller of new crop wheat. And we are still 20 plus cents above the revenue insurance price. So we wouldn't expect too much as far as a claim on price loss this year unless price really drastically drops. And we sure hope that doesn't happen. Looking ahead to 21, just for, to kind of give you a reference point, go back to Kansas City 20. We're at right around 460. That 21 market's at 504, so a 44-cent carry. So kind of like corn, we're seeing some big carries in this wheat market. So for those of you that with space that have the ability to store, maybe you don't look at selling the July 20 contract. Maybe you look out to the December, into the March, maybe even all the way out into 21 as an opportunity to hedge some wheat at some better numbers. So I just wanted to show you these. I'm not a big proponent right now. I do think the 100-day moving average in Chicago 21 wheat around 5.5, probably not a bad target. Maybe you get Kansas City wheat up around 520, 525. Probably not a bad place to maybe start trickling out a hedge for the 21 year. The cotton, the balance sheet looked pretty ugly in cotton yesterday. USDA tried to help us by reducing harvested acres slightly, but they made up for it by increasing the yield quite a bit, in fact, which ended up taking production up, I believe, 110,000 bales. And they dropped domestic usage, took ending stocks up 400,000 bales to 7.1 million bales. So not a good balance sheet in the old crop. Looking ahead, USDA did use its prospective plantings acreage of 13.7 million acres. That's probably a little high, I would tend to think. I think most people think that's probably the case. They used a yield similar to this year, give us production at 19.5 billion bushels, and ending stocks at 7.7 billion, or excuse me, million bales. That's a big, big number. I've got records in my database going back to 07. This is the biggest stock number that we've had in those years. So unless something happens to threaten the crop, if we reduce acres, we've got some way to take that down. But boy, this is a big, big starting point. USDA did lower its average farm price to 57 cents here for this coming year. So the cotton market has rebounded off these recent lows this month. It's been a good month in trade in cotton, but we're still not back to where most people would like to be, certainly from a profitability standpoint. I had hoped and would hope that there would be a way we could trade back up around 70 cents. You've got the 50, the 100, and the 200-day moving average all in the 72-cent area. So that would be a heck of an opportunity to hedge. Hindsight's always pretty good, but boy, we get back up to that area, I think I would be a pretty good seller in this old crop cotton. Now, looking ahead, I did an alternative balance sheet. Let's say acres come in at 13.4 million. So we do dip back a little bit. That's still not enough. And I did bump my demand number a little bit as well, but that still takes stocks back down to where we were this year. And so and maybe you raise your price back up to 60 cents. But so it's going to take some drastic cut either in production of acres or in yield, likely to get us much of a bounce here in this cotton market this year. So we put together the matrix as well for cotton. You can kind of see what it takes. USDA's current numbers right around 7.7 million bales. You're going to have to take yield down around 800 pounds, 810, and maybe reduce acres significantly down below 13 million. That just gets your stocks down still above 6 million bales. So something's going to have to give, either a problem in Southeast Asia, maybe China steps into the market again for U.S. cotton, something drastic in order to really get much more than a 3-4 cent bounce in this market as we go forward. Now we have come up off the bottom. We're 7 cents off the lows right now in December 20 cotton. And if you look back a month ago, we were talking about the policies and how this policy had really provided some put protection. We had dipped RP down close to the 70% or a 30% loss in price from where the base price was set back in the spring. Now that prices have come up, most of the policies are probably not in the money. If you've got the SCO coverage, that's a 60 cent level. So an average county yield, we would still at least have some price protection built into your policy. For this market, I'm staring at this 100 and 200-day moving averages in the 63, 64 cent area. And that's about 6-7 cents above where we're at today. I think if we get back to that level, A, I would look to hedge a contract. B, I still like that put-call strategy. Buy a put, sell a call. And if we get back up around 63 cent cotton, probably be looking at a 62 cent put. Maybe I sell a 65 cent call, set me a floor at 63 or 62, take a ceiling at 65. If I can get that done relatively close to even money, then at least I can have a floor in this market in case we go back down to 50 cent cotton. And if we have a carry out over 7 million bales, there's probably a possibility that could happen over the next year or so. Looking all the way out into next year, really the market's pretty flat, 58 cent out into the 21 year. So I don't really want to do anything out there from a market perspective, but I do think like the 20 crop, if we're able to get up around this 63, 64 area, you would have an RSI at that time, probably in an overbought status. And I think that would make sense to be doing maybe a little hedging on out into next year as well. The livestock markets, boy, you've all seen the production numbers recently. the fact that a lot of these packers are shut down or slowed way down. We've seen a number of closures around the country, and that's really showing up here. That cattle slaughtered, hog kill, both dropping substantially below really to record levels in the last few weeks. The boxed beef price skyrocketing over the last few weeks due to the packer closures. We've all been in the grocery store, probably seen a lot of fairly barren meat shelves, I guess, at this point in time, and probably seen prices start to inch up there in the grocery store as well. So we're hopeful that a lot of these plants are going to get back up into production. But we're going to have the testing and wherewithal to be able to get that to happen. The live markets or the futures markets have started to kind of follow the boxed beef or the box charts. We've seen the cattle futures jump, live cattle back up to 101, which as of yesterday, it was really the highest close that we've had in the August contract in 2 months. We're right at the 100-day moving average. I don't think it's a bad place to be doing a little bit of hedging. We got the RSI at 67, which would indicate we're getting a little bit toppy. So right up into this 101 to 106 area. The 106 is the 200-day moving average. For those of you that are able to hedge, and maybe it's not the August contract, maybe it's out in the deferreds, but I think that's not a bad place to be doing some marketing here. Feeders, kind of the same. The RSI is not quite as firm, but around 60 right now. If we get a little bump, this 100-day moving average at 139, probably a pretty good target in the August feeder contract as well. And if you're marketing in some deferred months, maybe you go out into the December, the February, whatever. But I do think that the cattle market is one where we're close to maybe getting a little toppy here as we go ahead. Now, hogs, those of you that have been listening to me for a while, and I'll date myself, go back to September. I've been a little friendly to this hog market, mostly because of China and mostly because of the recognition that I thought China needed to buy U.S. pork, and it's happening. Since the beginning of the year, we've seen cumulative exports to China of pork skyrocket, and so China is spending its money as we kind of thought it would on buying meat rather than buying soybeans and soybean meal. Now, the hog market hasn't responded. It's actually dropped going from January into April, kind of like all the other markets did. It really followed the other commodities as well. But over the last 30 days, it's had its share of upside trade. Here this morning, we're down a little bit, but we're trading around $60 hogs right now in the August contract. If we push back up into the 70s, I would certainly want to get fairly aggressive marketing, maybe not just the August contract, but some of the deferred contracts as well. So then that's the 100-day moving average, the purple line. That would probably push our RSI up over 70 and probably give us an opportunity to be doing some marketing there. So as far as the markets going forward, these are, I think, the most important things right now. U.S. economic startup, that's as we continue to get hopeful of that. It's given support to the oil market. It's given some support to the stock market. I think that can carry over into the other commodities as well. I think the Chinese phase one buying is a big deal. If China continues to be in the U.S. market, that's going to give us some support. Actual planted acres. We do get a report from USDA on June 30th, which is considered to be its planted acreage report. I realize all acres aren't certified by then, but this is their estimate of acres at that point in time. So between now and then, we're going to be watching the planting progress numbers every Monday afternoon and see which states are lagging behind, which states are making good progress. And then finally, growing season weather. What's the weather look like out into the 2-week, the 4-week forecast? What's the summer forecast? And if we get any kind of a hiccup, certainly it could bring some fun buying back into some of these markets, especially like corn, where the funds are short right now, cotton. But again, we'll have to wait and see what happens there. Revenue insurance, and I showed this slide last month, but keep in mind that your revenue insurance policy acts as a price put option, and we pointed that out with these charts, that if price drops enough, you could be triggering a revenue loss due to the drop in the price. and we get our yield put option. We all know that, you know, you've got a bushel guarantee from your policy. If you fall below that number of bushels, then the policy pays you back as well. We also have a call option in the policy. If there's a drought like 2012 and the price skyrockets and you lose bushels, you get paid at that higher price. But our focus for the most part is on this price put option right now. That's where the policies are working for us. And I showed you these charts, but I'll show you again. Here's what December cotton looks like. We've got I put these lines on the chart to show you how the policy, at what levels this policy is working. Same with corn. We're down into this 85, 86% range right now, 14% loss from the revenue insurance base price. We're well below the margin protection 95% price. So these policies are working for you right now from a price perspective, from a put option perspective. The margin protection insurance, just kind of put it into numbers. This is the calculator that we get to use. Watson Associates allows us to use this calculator. It's a fabulous tool to be able to look at the numbers. But the margin protection insurance policy, for those familiar with it, we just set our second prices, or what we call our harvest prices for some of our inputs like urea, DAP, potash, and diesel. Those were all set here in the month of April, so those are final. So margin protection is kind of like a county insurance policy where you use a county yield and a starting price, but we also subtract input costs. Some of those are fixed, like down here on the left-hand side, it shows you $206.90. Some of these are variable, like urea, DAP, potash, diesel, and interest rates. 4 of those have already been finalized. Interest rates get set in the fall. Then margin protection also uses a harvest price. So if the harvest price goes up, you get to refigure your trigger for the margin policy. But for the most part, this policy has got its input prices set. And if the price stayed at 334, where it was yesterday when I updated this calculator, this particular county or any county, if it had a yield exactly at its beginning expected yield, you'd be looking at a $113 indemnity payment. So this is how the policy is working. And if I go back to this chart, it shows this trigger, 95% trigger at 383. And as long as the harvest price stays below 383, you know, if we're staying at the levels we are right now, we're looking at a substantial indemnity check. This is how your revenue policy works as well, or SCO, or any of those policies. If we stay below those triggers, and depending on your yield, we're looking at some potential payments at the end of the year. Speaking of margin protection, and I did show you the 21 chart just a few minutes ago on corn, and showed you where that those prices are 30 cents above the 20 price. I wouldn't ignore that, A, from a marketing perspective, but B, from an insurance perspective as well. And I mentioned also that my target, you know, I'm looking at this purple line, this 100-day moving average. If you get up close to 385, up under that, maybe is a good time to maybe do some marketing. But you can also use some of these tools like the R-Powered and the M-Powered products from NAU to be able to establish your insurance price early. So if we get a 20-cent bump, I'm not saying we will, but if this market goes up 15 to 20 cents, maybe I want to consider locking that price in for next year's crop insurance as well. And when I say lock it in, you're setting a floor, because if I were to lock that in at 383 or say 385, then in February or September, if the insurance price for next year for margin protection in September is above that, I get to use the higher price. If the price in February for revenue insurance is above this level, then I would get to use that price. But I'm at least establishing some sort of a floor that in case this market goes down and stays down later, that at least I've got that locked in for next year. So just wanted to throw that out there so that you've heard it. We can talk about it more in the weeks ahead if this market bounces back. Certainly that's something that I might be writing about in the market report as well. So just kind of keep that in mind. The other thing I do want to mention is the Easy Rev that NAU has. We can now quote that for next year. And so Easy Rev is basically the same as the R-Powered, but it's a packaged group of months. And that makes it a lot easier to be able to utilize this program. And what Easy Rev allows you to do is to be able to utilize other months of the year other than the February price for the revenue insurance policy to be able to establish your base price or your guarantee. And so I ran a quote the other day for Jackson County, Minnesota, which is pretty common for much of the Corn Belt. And this is an 85% insurance policy for next year. And the quote to add the months of May, June, and July of 21. Keep in mind, the reason we might do this is the seasonal tendency for the market maybe to swing into the summer months. And so this quote ran, it was less than $6 an acre. If I divide that by my bushels, it's about 3 cents a bushel. So I can add that at some, and I don't have to do this today. I can do it, a month or two down the road. I can even do it in next spring. It may get a little more expensive the closer you get to some of these months. We've seen that happen in the past. So I just wanted to throw that out, kind of some food for thought, that we were able to quote this. You're able to look at these numbers now, talk to your NAU agent. You can start to make some plans for the 21 year and be kind of thinking ahead. What do we expect to have happen in price? If prices do go down and make lows in the fall, and then maybe, I don't know what February is going to be like, but, next year, do we think we're going to plant 97 million acres of corn again? Yeah, I would tend to think probably not. So maybe we swing some of those acres. So with fewer acres a year down the road, if we start out with a lower price in February, maybe there's better odds of a rally next summer. So I just wanted to get you thinking down the road of what could happen, and that we do have tools to be able to help manage in the event that we see these prices improve out into next year. And the neat thing about the Easy Rev quoter, there's some great historics involved here. Historically, they go through and do the math going back to 1999. Over the last 20 years, 71% of the years we tend to see May, June, and July price, and this is a monthly average. One of those months is higher than the February price. 81% of the years it's higher than the harvest price. 57% of those years it's higher than both of them, which means that you're going to get a higher price, and 57% of the years means you're going to get a higher revenue guarantee from your policy by using the Easy Rev product for those May, June, and July months. So it doesn't necessarily mean you get paid, but it does mean that your insurance guarantee or your trigger would increase, which means that you're getting more dollars of coverage, which ultimately means that you've got more ability to sleep at night. You can borrow more money if you had to from the bank, whatever the case is, from your policy. So just wanted to throw this out that we have it available, and we'll be talking about it in the months ahead. The farm program. Farm Doc put this out the other day. Everybody that elected their programs made your program election for the 19 and the 20 marketing years. So for the year that we're in right now is the 19 marketing year. The 20 marketing year starts September 1. So those are the 2 years that we've been talking about in these balance sheets. And this shows which programs we elected by crop. Corn was about 75% to the PLC program, about 6% to ARC individual. The rest of them went to the ARC county. Go down to some of the other crops. Majority of the crops went to PLC. Oats were about a little over 60% PLC. There were some folks that went to ARC and oats. I understand that up in North Dakota and some areas, maybe even to the west in Montana, that we did see some county yields on oats that would have been favorable to get ARC payments. And so some people were suggesting that. Soybeans, just the flip. ARC was about 80% participation, about 15% or so in PLC, and the rest went to the ARC individual. So wheat heavily into, and seed cotton all heavily into the PLC program. So here are the updated prices. I've showed you some of those on the balance sheets, but the ones in the gold box are the estimated market year average prices for both the 19 marketing year and the 20 marketing year. The ones that are highlighted in gold, which is everything other than the current year soybeans, have prices below the PLC reference price in blue on the left-hand side. So every one of these crops in each of these 2 years, except for old crop beans right now, would be low enough to be triggering PLC payments. So that's the reason I know a lot of us didn't go to PLC on beans, is because we didn't think we would trigger a payment this year. So we wanted to have a chance at an ARC payment. And so ARC is over here on the right-hand side. These are the benchmark prices for ARC for the 19 year and then for next year for the 20 year. But for the 19 year, we were focusing on this 963 and doing the formula for ARC. You know, the odds in some areas that had poor yields in soybeans were pretty good of seeing an ARC payment for this year. So that said, let's go through some examples. I've updated all these from let's go through. Here's what corn would look like right now for this year. We had a 360 price, market year average. That would trigger a dime payment if that holds through the end of August. You'd take that dime times your payment yield at FSA times 85% of your base acres would be triggering about a $12 to $13 an acre PLC payment. Those are made on base acres, not on what you produce, but it's on your base acres. The other thing to keep in mind is if you enrolled in the PLC program, you are eligible to add supplemental coverage to your policy. SCO is at 86% coverage. It's a county-based coverage that goes down to your individual level of protection. For sorghum, 19 right now, we're looking at 3 1/4. That would trigger a 70-cent sorghum payment. Multiply that by my payment yield times 85%. I'd be looking in this example $40 to $50 an acre for sorghum for PLC this year. For wheat, USDA left this number unchanged at $4.60. That's still triggering a 90-cent payment. Take it times my payment yield times 85% of my base acres. I'd be getting about $30 an acre on my base acres for wheat this year. Again, depends on your payment yield on your farm. Cottonseed, USDA hasn't updated this. Now they will, and they likely won't change it because the cotton price didn't change, but these get updated a few days after the WASDA report that came out yesterday. But the last update that they had showed cottonseed at about 29.6 cents, which would be triggering about a 7-cent payment. Take that times my payment yield on cottonseed times 85% of the base acres for cotton. And in this example, I'd be getting over $100 an acre. So we still expect that cottonseed payments are going to be fairly large. For ARC, the reasons people went to ARC is maybe you had a lower county yield this year. So in this example here, we go back to the numbers on price. Let's say that my county's Olympic average yield starting was 150 times 370 benchmark, gives me a 555 benchmark revenue times 86%. My county's trigger for the ARC program was 477. If USDA's price estimate at 360 holds, my county yield would have had to lose about 18 bushels below last year's starting yield in order to trigger a payment. Now, good news, FarmDoc did the work for us. Here's the map of current, what we would currently be looking at on ARC payments. Our FarmDoc used a 350 MYA price. And so you can see in green which counties might be triggering some payments. And there's a swath up into southwest Minnesota that's getting some big money because yields were down last year. We've got some in the Ohio Valley up into Ohio. We've got a swath across northern Illinois that was on the edge of where we had a lot of prevented plant. In addition, down into the Delta states and in the southeast as well on corn this year, where yields were down. So kind of shows you where, and you go back to the chart, 15% of us signed up for the ARC program. You know, we would be looking at potentially some money in those areas. In fact, in some of these dark green, $40 to $80 an acre. So some pretty large numbers at 350 price. Soybeans. The reason a lot of us went to the ARC program on beans is because of how high this benchmark price was and that we had bushels that were expected to be down. And because of the drop in the price, and USDA, by the way, lowered this number to 850 this month, that means that my county yield only had to be down 1.3 bushel an acre from the expected yield in order to start to trigger an ARC payment for the 19 year. Now, FarmDoc updated this the other day using an 850 price, and you can see a lot of green on this map. And those are $40 to $80 an acre. So again, southwest Minnesota, the Ohio Valley states, down into Kentucky, eastern Illinois, we saw some significant ARC payments expected to be paid this year. And up into North Dakota, some big wide area expected to get at least $10 to $30 an acre because of yields were not great, but also with the price drop, we would assume some payments this year for the ARC program. And that's why 80+% of the people, I believe, signed up for ARC. And that was our suggestion throughout the winter, that if we did not think PLC would pay this year, then you might as well sign up for the ARC program because we get to start using that 963 price. Now next year, we'll see what happens. For corn, if we meet USDA's way too early price estimate next year, but let's assume we go down to 320, we'd be looking at a 50-cent payment on PLC for the out into the 21 year. That would, in this example, pay over $60 an acre. Soybeans, if we get to 820, okay, so this goes, back and forth on should we have done ARC, should we have done PLC. If you did PLC, you wouldn't have gotten a payment right now for the 19 crop year, but for next year, assuming we go to 820, here would be the math. We would get 20 cents a bushel times our payment yield times 85% of our base acres. That's only going to pay about $6 to $7 an acre. So, my suggestion throughout the winter was if you think that ARC will pay for the 19, take the money. If you think there's a good chance, then I would sign up for the ARC program because there's no guarantee of what's going to happen with PLC out into the 2020 marketing year. And that's kind of what we're seeing here. Those that did sign up for PLC still have possibility of getting some money here next year and still have the opportunity to sign up for the SCO program on their soybeans if they wish to do so. So there was no right or wrong answer, but just wanted to show an update. Here's what it looks like as of today. So kind of closing, here's what the calendar looks like. Memorial Day coming up. We'll have the markets closed on that Monday. We have our June WASDA report on June 11th. More than likely, USDA won't make any adjustments to the acres or the yields at that point in time. They'll probably wait until July at the earliest before they do that. But we will be looking for some changes possibly in demand. We'll have our aftermath webinar the following day. June 30th is a big report day. We'll get the June 1 grain stocks report that day, as well as that planted acreage report. And so that'll be when USDA makes its first adjustment to those acres, we think. And they may or may not, depending on what they're seeing at that point in time. Independence Day is observed on July the 3rd. A lot of places around the country expected to open up about that time. So we'll see if that does happen. July 10th, we'll get our WASDA report, and that's when we will get USDA's acres plugged into their balance sheets. And so we'll be able to evaluate their expected changes at that time. We'll have our webinar, our aftermath on the 13th. Since the WASDA report comes out on a Friday, we'll do this on a Monday. And then July 15th is a big day for us in crop insurance. That's our production reporting deadline. It was pushed back to the 15th. Acreage reports are due the 15th as of right now. So a lot of deadlines coming up here in the middle of July. So that's the calendar looking forward. So I did want to remind everyone that we have a lot of ways that you can access commodity market information. I put out my opening bell phone call at 8:35 in the morning every day. It's a good 2-minute update on the markets, what's happening and why in the morning. Right after the opening bell, I send a market report email letter out at night. So if you'd like to receive that, let us know. We can get your email address, get that sent to you on a daily basis. This aftermath webinar we do once a month. And then I also record a podcast every so often called Kicking Up Dust. And I did record one of those yesterday. You can access that through Podbean. If you subscribe, you can get a notification whenever I update that. But every so often when the market's moving, that's a good way for me to get a lot of words in a few minutes and get you an update on what's going on in the markets. So that's our objective, is to try to get information out to you that you can use in your marketing or in your crop insurance business, whatever the case is, and to help you be more successful. Also want to give a plug to our Field Insights program. That's a great tool. You can access this on your iPhone or on your other phones. You can access it on the computer. Shows you a lot of moisture information, wind information, just a lot of good weather information that you can utilize. You can plug in. You can put your farm maps on there so you can look at exactly which farms are doing what the weather situation is there. It's just a great tool. I enjoy using it on my dad's farms on my phone. Also, coming up here, not very long, less than an hour, we'll have our next installment of the NAU Country Connection. Adam will talk about crop hail applications and quoting. And so if for those of you who want to get back on another call here at 11 a.m., we'll go through the crop hail app, and that pretty important information this time of the year. Next week, we'll talk about self-certification as well. And by the way, also down here at the bottom, I mentioned all of our training videos, marketing webinars, including this one, are available on the NAU Country YouTube page. So if you want to listen to it again, or if you want to check out some of the other things that you may have missed, you can go to our NAU Country YouTube page and see all of those webinars and view those at your leisure. So with that, I appreciate everyone joining in today. We went a little extra long today. We had a lot of topics to talk about with those new reports coming out with the government programs. So I appreciate everybody taking the time to join in, and wish you a safe and successful month ahead. Thanks a lot.